Joining us this morning is benchmark analyst Matthew Harrigan. Matthew, great to have you. There's been so much conversation about expectations on the buy and the sell side going into tonight. The argument is that on the sell side, at least, they've gotten a little overheated. Would you agree?
Absolutely, this has gotten overheated. I think that Netflix is in an advantageous position relative to the other studios, given the sizable international production, which does have some appeal in the U.S. and a good backlog of shows. But I think this is behaving like it's a category killer tech stock, and I think that at heart, this is really a media stock that's subject to a number of issues that beset, the industry. I think the way to look at this in terms of the TAM opportunity is really the overall TV market, which continues to be challenged both on the subscription and the advertising side. And we haven't been perma-bears on this. I had a buy on this a few years ago when they really jacked up prices. We had a sell going into the collapse last spring. Clearly, I should have been more agile in upgrading this. But I do think that at this level, it's fairly heinously overvalued relative to the underlying business.
To the degree that a strike is one of these dynamics that could impact it, what do you say to those who are trying to thread out the idea that their production relative to peers is highly international? They're able to monetize things that come out of, say, South Korea. That it would create ways to keep them immune from a labor work stoppage.
Well, I think Netflix is really to be lauded for taking the international content into the U.S. and having a global hit like Squid Game. But I don't think it's sufficient. I mean, people are not going to live on a diet of South Korean dramas or German, horror epics. And really, I think a number of their near peers, I won't call them peers, but even Peacock, certainly has sports and news, which won't be disrupted by the strike. So I think that, relative to other studios, they have some advantages, but it's going to be really bad if this is a long strike. And it does look like it's going to be a long strike, and it's certainly going to be disruptive to what's in the hopper for 2024.
Has Netflix ever traded like a basic media stock?
You could argue last spring the market was certainly becoming more realistic and looking at the gap versus the peers. Right now it's trading around 28 times EBITDA, so it's really at a fairly crazy premium to when you look at a Comcast or Disney, certainly.
But it's not dependent on, not yet, on ads like they are. And, the whole first mover advantage into streaming that everyone had to chase, that was the bull case. And then the further bull case is that the market's bigger than everyone thought because they're cracking down on password sharing.
Well, I think that the password sharing and the entry into AVOD initiatives are absolutely vital to justifying the valuation. And we actually have that embedded in our forecast. I actually have them adding more customers than consensus next year, around 21 million. And they are going to be subject to the advertising market when you look at the emphasis on AVOD, which is going to be how they're achieving a lot of the subscriber growth to complement the crackdown on password sharing. So they're going to remain a leader. I mean, this is a great company, phenomenal execution. But I still think years ago, this really was more of a tech company. They had a really decided advantage in the quality of experience relative to their peers, much more programming. And clearly, I think this is probably kind of an 80-20 media versus tech company at this point. I mean, everyone else can pretty much do the same thing that they're doing on the streaming side. It's just really a matter of content creation and what you have to back that up.